The topic about impact of interest rates on stock markets. Let's dive into the introduction part. What is interest rates? Interest rates represents the cost of borrowing money decided by the central banks like RBI and Federal Reserve. There is an inverse relationship between the interest rates and stock prices. When interest rates high, stock prices may go down. When interest rates low, stock price may up. And now go into the key matters. Repo rate and federal fund rates. The rate at which Reserve Bank of India lends money to commercial banks is called repo rate. Current repo rate is 5.50%. Federal fund rate, the interest rate at which US banks lend to each other overnight, guided by the Federal Reserve. Current Federal Reserve rate 4.33%. Let's dive into the impact of interest rates on stock market. In this chart, there is two phases, rising phase and falling phase. In rising phase, rising interest rates, borrowing cost may be expensive. Loans become expensive like car loan, home loan, business loan, etc. And consumer demand, people spend less money, avoid by high purchases, and that will impact on the corporate profits, and that will impact the stock price may go down. In falling stage, loans become cheaper, easy to borrow home and car loans. People spend more, and companies will earn, and automatically stock price will go up. And if we come to examples, if RBI increase rates, fewer people buy new cars and automatically company profits may fall. Stock prices also falls. If RBI cut rates, house loan get cheaper, more people buy houses, real estate and cement company stock prices. Let's dive into the sectoral impact of rising interest rates. We can see in this pie chart when interest rate hikes, only banking and financials only in a growth stage. Remaining all sectors may be that will impact automobiles, real estate, FMCG, IT. We don't in red color, no. Normally, stock reacts sharply to rate hikes and cuts. Mostly when hikes, winners are banking and financials. Higher lending boosts margins. Losers, IT and FMCG, hit by reduced global demand and consumer spending. Real estate and automobiles, costlier loans, reduced demand. Here is the market reactions. In this graph, we've seen that 2020 RBI cut repo rate sharply because of COVID support. Market drastically increases. In Nifty 50 rebounded strongly. In 22-23, repo rate hikes to fight inflation. Nifty corrected but later adjusted. Here we can see in this graph Nifty controlled rate hikes. Market corrected in this stage 2022. Let's go into the US market. In 2020, interest rate slashed zero. Market led strongly. In 2022, markets hiked aggressively. Stock markets corrected. 2023, high rates slowed recovery, but market stabilized in this 2023 stage. We can see in this graph. Now dive into the challenges and opportunities. The challenges mostly uncertainty in global markets. Foreign investors pull money out during hikes, sectoral slowdowns. Opportunities like banking and financial performs well. Defense stocks safer in higher rate periods. Long-term investor benefit from this correction. Okay, next conclusion part. Interest rates are key drivers of stock market cycles. If rate hikes, short-term pain but control inflation. Interest rates high, stocks down in short term. Stable rates, long-term equity growth. Investors must track RBA and Fed policy decisions before investing. Thank you.